This is 2, and in this short web video, what we're going to do is go over how to use the solver and the data analysis tool pack in order to start to develop optimized portfolios. So as you recall, if we click here on our returns, we have 5 stocks that we're using for our portfolio, and this represents the return series. We had used the prices and downloaded the various return or price series from Yahoo Finance. So our first step is to develop this variance covariance table. So in order to do the variance covariance table, what we want to do is go under the data analysis and we'll click on the covariance. Before I get there, in case you don't have data analysis, very simple. What you want to do is go to File and then Options, and then you're going to go to Add-ins. You can see up here we have the toolpacks, currency, and the solver add-in. You'll just pick analysis toolpack, for example, and it should load everything up. But you'll need to add those in. Alright, so back to the analysis here. Data analysis, what we're interested in is covariance. And I've done this before on original, I have it set up, let's say. So what we're going to do is go to the returns section. We're going to highlight what we need are the return series. Start with the ticker symbols that we're interested in, and then pull down all the way to the bottom of the return series. And make sure that you have labels in first row. And then our output is going to be in the sharp. And what we want to do is just set it right here on A12 and hit the return button. So data is going to go, that's our data, labels in the first row, and we're going to go ahead and hit OK. And it says the output range is going to overwrite something that's existing. That's fine. We go OK again. So here we have a variance covariance matrix, or the beginnings of one. On the diagonal is the covariance between 3M and 3M, and that by definition is actually the variance of 3M. And then DD and DD. So the diagonal is the variances, and the covariance is between 3M and DD is going to be here, and UPS and DD is here, and HD and 3M is here, and again 3M and Procter & Gamble. So what we need to do is populate these rows. Very simple. We can highlight the column, hit Control-C to copy. We'll come over here, and on the Home tab, paste, we want to do a transpose. So that's going to take this row and turn, this column and turn it into this row. We're going to do the next one. Again, staying off the diagonal. Control-C, click here, and paste. Triangular. Do this one, Control-C, click here, and then paste transpose. And then the last one, since there's only one, which is a Control-C, Control-V. And then for organizational purposes, we want to clear the borders, no borders. So here's our variance covariance matrix. The next thing we need is our weighting array. And our weights, before we get to our weighting array, we're going to come up here to what I call the consolidation table. Alright, here's a list of our stocks, 3M, DDD, DD, UPS, HD, and P&G. Our betas, we got our betas from Yahoo Finance, which we showed in the last video. The expected return, in order to do that, we're using capital asset pricing model. Here we need the risk-free rate, B1, add to that market return minus the risk-free rate is quantity times the beta. The dollar signs here we'll go over in a little bit, but they basically mean that's the reference cell that won't move when you drop and drag. Okay. Risk-free rate, I'm using the LIBOR 1-month rate. If you just Google LIBOR rate, bankrate.com will come up and you can see that there. And market return, I'm using 10%. There's a number of studies out there that show that the expected return in any given year is going to be either between 10 and 11%. So that's what we're using. The weights are going to come from our solver. You start out by just guessing something. I'm going to say here 10, 30, 20, 30, and 10. Just as this should be 30. Just as a starting point. We want to make sure that this adds up to 100%. You can go ahead and sum here if you want. So we just equal the sum of the column, highlight the column, and we're good. Now we're at 100%. The contribution is the expected return times the weight of the portfolio. This is 10% of the monies invested in 3M. And we're going to sum these guys up. The sum of the contributions of each item in the portfolio is the portfolio return. So that's just the sum of that column. And we also have a calculation of beta. This is a function in Excel called sum product. You'll highlight you'll type in sum product. You'll highlight the first array, highlight the second array, which is the weights. And what it does is it multiplies the first items in each array, and then adds them to this multiple of the second two items plus the multiple of the third two items, etc., etc. So it's a quick way to get everything multiplied and added together. And this is our current portfolio beta, which would be 1.1. That brings us down to the weighting array. You'll notice that the 3M here is equal to D4, and this is D4, which is our actual weights, and this is also equal to D4. And what the solver is going to do is it's going to change these values, and as it changes these values, it's going to change our weighting array. Okay? Now, each item in the weighting array is this weight times the cell. So if that's the 1, 1 cell, then we're going to multiply it by this value. And then again, we're going to multiply by this one. So I can double click here. It's 10%, A22 times the variance of 3M times A22. Now, I want to show you here how to do this relatively quickly. The first thing that we're going to do is, what we want is for A22, as we drag it downwards to go to 23, 24, 25, 26, and we want B21 to remain the same. So click up here, and if you hit F4 and F4 again 3 times, it takes all the dollar signs out of out of A22, and then we're going to hit dollar signs here. And that means keep B, if it's got a dollar sign in front of it, it means always be B, and then always be 21. Alright, so that is our setup, and then what we can do is go ahead and drag this down. And what you see here is we got 23, 21, 24, 21. So it's always going to be the element times the element times the column header. Alright, so that's a start. Now we want to go ahead and drag them across. So in order to do that, we'll come back here. We want that to remain constant, and this one to actually change. Hit the return key. Again, this stays the same. This varies, and what I'm doing again is hitting F4 in order to get this variation, or to get the dollar signs to move. Again, 25. And the final one here. Alright, so now what we want to do is highlight the whole column, come over to our cursor changes from the heavy cursor to the light cursor, and then just drag it across. So we now have our full array. That's 22. Right? It's A22 times F13 times F21. So we're good. This is the variance. These are the covariances. To get the total variance of the portfolio, we need to sum everything together. So first we're going to do is by summing the columns. So all we do is use the sum function and come down here to sum the column and all the way through. Now remember that we use monthly returns, so we're actually dealing with monthly variances here. For our annual volatility calculation, we want to find the variance of the portfolio, which is then all we're going to do is sum up this row. So if we add everything in this array together, that becomes the variance of the portfolio. And we want volatility, so that means we're going to take the square root of it. So we're squirt the sum of this. And then since we're dealing with monthly, and what we look to is an annual, we want to multiply it by the square root of 12. Okay? Our annual return is just set equal to the sum of our contribution column. The Sharpe ratio is a measure of your portfolio efficiency, and it is defined as the expected return, which is our predicted return here of 11.4%, minus the risk-free rate as a quantity, all divided by the volatility of the portfolio. And then our leverage, what we want to do here is it's 1 minus the sum of D4 through D8, which is our weights. And if you borrow money, then you're going into debt. You borrow the money and then use it to buy stock that becomes leveraged. So we're not going to do any kind of leverage portfolio calculations here. But we do also want to completely invest so that all this adds up to 1. All right, so our next step is to go ahead and run a solution on this. For that, we want to go to the solver. And I've already run a solution here, but I want to go over how do you set it up. First thing, you need to pick an objective cell, a cell that you want to maximize, minimize, or bring to a particular value. In this case, it is cell C31, which is the Sharpe ratio. So what we want to do is maximize the return for a given level of risk. In addition, we want cell C32, which is our leverage, to be equal to 0, which means the sum here should be equal to 100%, and then we're not borrowing anything, so leverage is actually 0. In addition, because we want a diversified portfolio, we want to have some percentage in each stock. So this requires at least 1% in each stock. We're using a nonlinear solution. We go ahead and click solve. Solution comes up. We're good to go. And here's our optimum portfolio and the portfolio beta. You'll notice that most of the portfolio is being invested in 3M and DD and very little in the other 3. So this is maximizing the Sharpe ratio, but it's also decreasing your underlying diversity. And that diversification is one of the things we look for in portfolios. So another way to do this is just a generic optimization, is to increase the number of constraints. We're going to go to our Sharpe 2 and click on our solver again. Here again we're going to maximize the Sharpe ratio, but we're going to add some additional constraints. First constraint obviously is the leverage, that's C32 set equal to 0. And for D4, which is 3M, we're going to want no more than 50%, but no less than 5. And that constraint is set for every one of them. In addition, we don't want to have a really high portfolio beta, so we're constraining our beta between 1.1 and 0.8. If we go ahead and hit the solve button on that one again, the solution is already here, but you'll see 47. So we're much more diversified in terms of evenly balanced in the portfolio. Our volatility has gone down. Our expected return has definitely gone down, but our Sharpe ratio hasn't changed too much. We're at 5.67. We were at 5.84. So a small change in the Sharpe ratio. Another way to do the optimization, well, What we're doing here is, rather than maximizing the Sharpe ratio, what we're trying to do is minimize the volatility. So we want the volatility, which is the risk level, to be as low as possible. Again, 100% invested and at least 5% in each one of the stocks. And we could add an additional constraint here. For example, we want to add a constraint that the annual return has to be greater than or equal to, let's say, 8%. All right, so we now have all of our constraints set up. We'll go ahead and do the solution. Solution was found. So our annual return here is at 8%. Sharpe ratio is 0.5. Volatility is at 15.8. And here are our weights. Our portfolio beta is basically 0.8 at that point. All right, so I hope that helps in terms of being able to walk through how to do the optimizations. And our next analysis will be on comparison of future data to, or in other words, we want to check out how our portfolios are doing. Thank you.